So, you think you've valued your family home correctly for inheritance tax? Well, what if I told you HMRC investigates nearly 1 in 4 estates? And believe me, they know a whole lot more than you might think. So how exactly do they do it? And more importantly, what can you do to protect your family's inheritance? Let's find out.
Yeah, just look at that number, 24%. We're talking about almost a quarter of all estates that owe tax. This isn't some random lottery, it's a systematic check. It means if you're an executor, there is a very real chance that the valuation you submit is going to get a second look. So getting it right from the start, isn't just good practice, it's absolutely crucial to avoid a long, stressful, and potentially very, very expensive mess.
And to make sure we're getting all of this right, all the insights we're about to go through have been developed by the experts at ProTax Accountant. These are the folks who deal with these complex tax situations in HMRC day in, day out. So let's dive into what they have to say.
So where does HMRC shine its brightest spotlight? Right here, on your home. The single biggest reason for an investigation is, you guessed it, undervaluing residential property. And when you think about it, it makes perfect sense. For most of us in the UK, our home is easily the most valuable thing we own. Even a small slip-up on its valuation can mean a huge difference in the final tax bill, and you can bet HMRC knows this.
Okay, to really get why that property valuation is so critical, we've got to look at the basic numbers. Every single person in the UK gets a tax-free allowance. This is called the nil rate band. For the 2025/26 tax year, it's set at £325,000. If an estate is worth less than this, you're generally in the clear. But for so many homeowners, especially down in London in the southeast, the value of their property alone is going to push them way over that line.
But wait, there's more. On top of that standard allowance, there's another really important number, an extra £175,000. This is the resident's nil rate band. Now, this only applies when you pass your main home on to your kids or grandkids. Put them together, and that can bring the total tax-free threshold for one person up to £500,000. And for a married couple or civil partners, you can combine these allowances, which means you could potentially pass on up to £1 million completely tax-free.
So you can see how this can go two very different ways. Let's make it real with an example. Imagine a freelancer in London passes away, leaving their house to their kids. The executor, maybe trying to save the estate a bit of money, values it at £800,000. But the accurate professional valuation, that would have been $950,000. That $150,000 difference means they've underpaid the tax by £60,000. Now, if HMRC investigates and finds this was careless, or even worse, deliberate, the estate could face a penalty of up to 100% of that unpaid tax. That's an extra £60,000 fine on top of the bill. It's serious stuff.
Which, of course, brings us to the million-pound question, doesn't it? How on earth do they know the true value of one specific house on one specific street? How do they spot these things? It's not guesswork, and it's not random checks. Now stay with me here, because how they find out is way more sophisticated than you can possibly imagine.
The answer is this incredibly powerful, all-seeing piece of technology. We're about to take a look inside the system HMRC uses to connect every single dot of our financial lives. It's like a digital dragnet. It's called Connect. And this isn't just some spreadsheet. We're talking about an £80 million supercomputer that holds a staggering 55 billion pieces of data on UK taxpayers. Its entire job is to weave together information from countless sources to build a detailed financial picture of every single one of us, from cradle to grave. And the amount of data it pulls from is just breathtaking. When you submit that IHT form, Connect isn't just looking at the form. It's cross-referencing it with Land Registry data for every sale on that street. It's checking Zoopla and Rightmove for old listings and local price trends. It can see if the property was being rented on Airbnb or if high-value items were being sold on eBay. It's building a complete digital twin of a person's financial life, and any tiny detail that doesn't quite add up with the valuation you submitted becomes an instant red flag. Okay, so having all this data is one thing, but how does a little digital blip turn into a full-blown investigation? Now let's look at the step-by-step process that takes a red flag on a screen and turns it into a formal letter landing on an executor's doormat. The whole process is really methodical, and it moves from machine to human surprisingly fast. So first, the Connect system automatically flags a mismatch. Let's say a property is valued 20% below the average for recent sales in the area. That's the computer part. Then it immediately gets passed to a human caseworker. If they agree something looks off, they pass it to their specialist property valuers. And before you know it, a formal inquiry letter is in the post. The key thing here is how fast a digital flag becomes a very real problem.
And who are these specialists? They're the District Valuer Service, or DVS. This is the expert property arm of the Valuation Office Agency. Just think of them as HMRC's own in-house team of expert surveyors. Their one job is to give HMRC an impartial, professional valuation to challenge the figures you've submitted. A valuation from the DVS carries a huge amount of weight, making it incredibly difficult to argue against.
And here's a pro tip that really highlights the long-term risk. While most checks are fairly recent, HMRC's powers are massive. If they even suspect deliberate tax evasion, they can look back as far as 20 years into someone's finances. So the point is, getting this right isn't just about the here and now, it's about closing the book on an estate for good. Honesty from the get-go is absolutely everything.
Okay, so we've seen how HMRC finds mistakes, and yeah, it's pretty intimidating. But now let's switch gears from the problem to the solution. This next part is all about the practical steps you can take as an executor to make sure the estate you're handling is secure and compliant from day one. So here's your checklist for getting it right. First, and this is the big one, get a professional valuation from a surveyor who's accredited by RICS. That's the Royal Institution of Chartered Surveyors. This isn't just an estate agent's guess. It's a formal report. It's your evidence. Second, you've got to document every major gift made in the last 7 years. They can still be part of the estate for tax. Third, keep meticulous records of absolutely everything. This proves you've taken reasonable care, which is key to avoiding penalties. Fourth, report all the assets, no matter how small. And finally, and maybe most importantly, get expert advice before you even start, not after you get that scary letter.
The timeline is also super important. As you can see, the clock starts ticking from the date of death. You've got exactly 6 months to pay any inheritance tax owed. If you miss that deadline, interest starts racking up immediately. After you've paid, HMRC issues a form that lets you apply for probate. That's the legal green light. From the moment that form is issued, HMRC then has a 12-week window to launch an investigation. If you get past that window with no contact, you're probably in the clear.
Let's be honest for a second. This is a lot to take in. Dealing with a loss is hard enough, without suddenly having to become a tax expert and a property surveyor overnight. The paperwork is complicated, the stakes are incredibly high, and the whole thing can feel completely overwhelming. But the good news is, you really don't have to figure it all out on your own.
And this is exactly why getting professional help is so important. For expert, clear guidance on inheritance tax, from getting the valuation right to filling out the forms to dealing with HMRC for you, you can turn to the specialists at ProTax Accountant. They provide that expertise and, frankly, the peace of mind that comes from knowing it's all been handled correctly.
If you need that kind of support, here is how you can reach them. You can get them on WhatsApp or give them a call on 07985 689 912. Again, that's 07985 689 912. Or you can just pop them an email at info@protaxaccountant.co.uk.
And just a quick final note. Everything we've talked about today is for general guidance, just to help you understand the landscape. When it comes to making decisions about a specific estate, which can have huge financial consequences, you absolutely must consult a qualified expert, like the team over at ProTax Accountant.